Okay, so let's dive into Ralph Lauren. They just wrapped up their fiscal year 25.
Right, and closed out that next great chapter, Accelerate plan, 3 years done.
Exactly. And the results looked, well, pretty strong on the surface. But the look ahead, fiscal 26, a bit more cautious from management.
Yeah, that's the real tension here, isn't it? You've got this great performance they just delivered, beating expectations, and then this sort of tapping the brakes on the outlook. So yeah, let's unpack that.
Okay, let's start with the results snapshot then.
Yeah.
What did Q4 look like?
Q4 was strong. Revenue grew 10% on a constant currency adjusted basis.
Better than expected.
Yeah, beat on both top and bottom line. And they really stressed it was broad-based, strength, everywhere, geographies, channels.
Okay, and for the full fiscal year, 25.
Delivered 8% top line growth for the year. And a really big point they made. Their international businesses, so Europe and Asia, record revenues. And now they actually make up the majority of the total company's revenue.
Wow. Okay, so international is really driving the bus now. That's a pretty big shift.
It really is. And reflecting that, adjusted operating profits, up 24% for the year.
24%. That's huge.
Yeah, way ahead of what they guided back last May. So, looking purely at the FY25 numbers, it was definitely a success story.
All right, so how did they pull this off, especially with, all the talk about a tough environment? Let's get into the strategy. First pillar, elevating the brand.
Right. They talked a lot about the brand's like authentic values and lifestyle appeal, how it connects across different generations, genders, globally.
And the marketing sounds pretty diverse, not just fashion shoots.
No, definitely not. It spans celebrity stuff, big sports sponsorships. They mentioned gaming, music.
Right. That Spring 25 Hamptons campaign. Saw that included Roblox, which is interesting.
Yeah, and physical events too, like in Dubai and Shanghai.
And the sports sponsorships seem huge. Australian Open, Winter Olympics tie-ins, MLB.
And they put a number on it, said those sports things generated over 23 billion impressions just in Q4.
Billion. With a B. Wow.
Yeah. So clearly aiming for broad reach. Seems like it's working too on the customer front.
How so?
They added a record 5.9 million new consumers to their direct-to-consumer, their DTC business over the year.
Okay, that sounds like a lot.
It's a high single-digit increase. And importantly, they said these new customers tended to be younger, female, and get this less price sensitive.
Less price sensitive. That fits the whole brand elevation story. That's key in this environment.
Exactly. And they're growing online too. Social media followers up low double digits, past 65 million. Big platforms like Line, Threads, WeChat, Douyin, TikTok driving that.
Okay, pillar 2. Driving the core, expanding for more. What's the core?
Core is about 70% of the business. Think cable nets, outerwear, hats, linen, the classics.
Right.
Those grew low double digits in Q4. They see that as proof. The core holds up well even when the economy's shaky.
And the expanding for more part.
That's the high potential categories. Women's apparel, outerwear again, handbags. Those were up high teens for the year.
Handbags doing well.
Yeah, double digits in Q4. And for the full year, Polo ID, the new Polo Play launch, seems to be clicking.
And all this ties into pricing power, right? AUR.
Absolutely. Average unit retail, they highlighted their multi-year track record there. AUR was up 9% in Q4.
9% is pretty strong. How?
Strong full price selling, less discounting, and just a better mix of products.
And they expect that to continue.
Yep. Guided for similar high single-digit AUR growth for Q1 of 26. That's really crucial. It gives them a buffer against inflation.
Okay, third pillar. Winning in key cities with their ecosystem.
Right. This is about blending everything, their own stores, partner stores, their digital sites, some wholesale, but all focused on the top global cities.
And DTC, direct-to-consumer, is big now.
Huge. 2/3 of the business. And it accelerated in Q4. Comp growth was 13%.
13% comp in DTC. That's impressive. Was that just online?
Nope, that's the key. Double-digit growth in both digital and their physical stores within DTC.
Both channels firing. Okay.
And they're backing it up with new stores. Opened 83 new spots this year, mostly partner stores, heavily focused on Asia, but also key cities elsewhere, like back in San Francisco, new spots in Beijing, London.
So strategically placing bets on physical retail in top locations.
Exactly. It's part of that integrated ecosystem approach.
All right, let's break down the regions, because you said Q4 outperformance was broad-based. But where did it really shine?
Europe was a real standout. Revenue up 16% there in Q4.
16. Wow. Which countries?
led by Germany, France, Italy, and the UK actually grew again second quarter in a row.
And within Europe.
Retail comps were super strong, up 18%. Digital was up over 20%. Even wholesale was up 14%, though that adjusts down to mid-single digits if you account for timing. And get this, operating margin in Europe hit 26%.
26% margin in Europe. Very strong. What about Asia?
Also strong. Revenue up 13%. Every market contributed. Retail comps up 15%.
And China, still going strong.
Very strong. Grew over 20% in Q4, and that was on top of a tough double-digit compare from last year. Yeah, driven by comps, new customers, those marketing moments like Lunar New Year. Japan also did well, mid-teens growth. Management's still calling for low double-digit growth in China for FY26.
Okay, so Europe and Asia firing. What about North America? Usually the tougher spot.
It actually came in better than expected. Revenue up 6%. Both DTC and wholesale helped.
6%, okay.
And they hit their highest Q4 adjusted operating margin in North America in over 8 years.
Really?
Retail comps were up 9% across both the main brand and outlet stores. Digital comps up 8%. Wholesale revenue itself was up 2% with some AUR growth there too.
But they're still cleaning up wholesale distribution.
Yeah, continuing that. Exited 60 department store doors in FY25. Plan is about 90 more in FY26, about half tied to Hudson's Bay.
So still pruning. And the outlook for North America wholesale.
But that's where they sounded explicitly cautious for FY26, citing those potential macro headwinds, even though things have been okay lately.
Got it. Okay, let's pivot to the balance sheet and cash flow. How are they looking financially?
Pretty solid. Ended the year with $2.1 billion in cash and short-term investments. Debt was about $1.1 billion.
Healthy position. And cash flow.
Generated $1 billion of free cash flow in FY25. Impressive number.
$1 billion. Wow. What are they doing with it?
Returning a good chunk to shareholders. $625 million last year through dividends and buybacks.
And going forward?
The board just approved a 10% hike in the annual dividend, plus authorized another $1.5 billion for share repurchases.
Another $1.5 billion. That's a significant buyback authorization. Signals confidence.
Definitely. On the inventory side, it was up 5%. They said that's due to demand and Easter timing shifting into Q1, but that it's well positioned.
And investments. Still spending.
Yep. Key city marketing, store upgrades, tech, and some very specific real estate moves, like actually buying their global Polo flagship building in Soho.
Buying the building. That's a long-term bet on physical presence in a prime spot.
Exactly. Underscores that key city DTC-led strategy.
Okay, so that brings us to the fiscal year 2026 outlook. The part with the caution. What are they saying?
Yeah, so first, they caveated it, said it's preliminary because things are volatile. Tariffs, inflation, consumer spending, FX, all that.
Understandable. So the headline number?
Expect constant currency revenues to increase low single digits for the full year.
Low single digits. Okay.
Driven mainly by growth still expected in Asia and Europe. But, and this is key, they expect that growth to be heavily weighted to the first half.
Front-loaded.
Wow.
What about Q1 specifically?
Q1, they actually see revenues up roughly high single digits.
High single digits in Q1, but only low single digits for the year, that implies.
Exactly. A much more cautious view on the second half. And they tied that to macro indicators, potential tariffs hitting, signs of U.S. consumer weakening, risk of a broader pullback globally.
But did they say they're seeing this slowdown now?
No. And this is the really interesting part. They explicitly said they have not seen any change in their underlying business trends carrying over from Q4 into Q1 so far.
So the second half caution is purely a macro forecast, not based on current business softness.
Seems that way. It feels like a proactive, maybe prudent macro call based on external risks they see looming rather than something in their actual results yet.
Okay. What about margins for FY26?
Expect operating margin to expand modestly in constant currency.
Yeah.
Mostly from SG&A leverage, basically getting more efficient as sales grow.
And gross margin, with inflation and tariffs potentially hitting.
They expect gross margins to be roughly flat compared to last year.
Flat how?
They think the good stuff, AUR growth, less discounting, better mix, will roughly offset the bad stuff, like potential tariffs and higher costs for non-cotton materials.
And they have levers to pull.
Yeah, they're looking at more pricing actions for fall 25 and spring 26. They already have some planned for fall 25 in North America and Asia.
The tariffs, when would those bite?
Mostly expected in the second half of the fiscal year. And they laid out their mitigation plan.
Like what?
Supply chain diversification is a big one. Said no single country is over 20% of production. And China to U.S. specifically is only single digits.
So they've spread their bets.
Right. Also working with suppliers on efficiencies, using AI and analytics for savings, and continuing that selective pricing and discount control.
They sound confident they can manage it.
They projected confidence. Pointed to the elevated customer, the bigger international mix, now 57% versus 45% pre-pandemic, much higher gross margins than before, inventory discipline, cost flexibility, basically saying we're built better for this now.
What about freight and FX?
Freight expected to be kind of neutral for FY26. FX also minimal impact expected for the full year on revenue and margins.
And for Q1 margins specifically, since revenue is expected higher.
Q1 operating margin expected to expand nicely, about 150 to 200 basis points, constant currency, mostly driven by gross margin expansion early in the year and a bit of operating expense leverage. Q1 FX also neutral.
Okay, so management's overall message seems to be strategy is working, stay the course, lean into strengths, but be watchful on the macro.
That sums it up pretty well. Strong brand, resilient model, agile supply chain, good balance sheet. Keep investing, but be prudent.
Gain the consumer.
They see pressure globally for sure, but believe their core, more elevated customer is holding up relatively well. Full price sales still growing nicely.
And that cautious U.S. second half view is definitely macro, not current trends.
They reiterated that point. And they expect AUR growth to keep going across all regions, driven by all those factors: elevation, mix, less promo, some pricing.
Marketing spend stays high.
Yep, maintain the high level to keep driving engagement, keep pushing those high potential categories, women's outerwear, handbags as they scale.
And the real estate plays, like Soho.
Fits the long-term DTC focus in key cities.
Yeah.
U.S. wholesale, stabilizing, but brace for headwinds in the second half. Keep trimming the lower end.
Europe's strength?
Down to brand position, the key city strategy working, finding white space for new stores.
Yeah, I know.
Still a big growth engine. Accelerating marketing, adding quality stores, strong comps, expecting low double-digit growth there in FY26.
And long-term, can margins go higher than the 15% they just hit?
They signaled yes. Said 15% isn't necessarily the ceiling. Potential for more through gross margin and operating leverage, while still investing. Growth comes from AUR, units, and new customers.
Did they mention any impact from, anti-American sentiment internationally?
They specifically addressed that, said they're not seeing it impact the business, that the brand's values are seen as universal.
Okay, so let's put this all together. What's the key takeaway here for someone watching the stock or the sector?
Well, I think what really stands out is you've got a company executing pretty well, navigating this choppy environment with what seems like a resilient core business, clear strategy, elevate the brand, focus on core stuff, win in key cities.
Right. But the big but is that outlook.
Exactly, that tension point. Strong results, especially overseas and direct, running right into this cautious forecast for the second half of 26, particularly for North America. And it's all pinned on macro fears, tariffs, consumer confidence.
And you have to ask, how effective can that mitigation toolkit really be if things get really rough? Supply chain shifts, pricing, can they fully offset major headwinds?
That's the million-dollar question, isn't it? At the same time, you can't ignore the commitment to shareholders. That dividend hike, the big new buyback.
Yeah, that signals they feel pretty good about generating cash, even with the caution. They're balancing investment with returns.
Okay, let's pivot slightly.
This is not financial advice.
This is not financial advice.
Okay, let's brainstorm potential angle here based on what we heard. You look at Ralph Lauren, RLF, management guides, low single digits for the year. Yeah, but front-loaded. Q1 strong, then caution kicks in for the second half.
Right. Caution based on macro fears they admit they aren't actually seeing in the business trends yet. From Q4 into Q1, things are still looking okay trend-wise.
And meanwhile, they just hit that 15% operating margin target a whole year early.
Yeah.
And they're explicitly saying 15% is not the peak. There's room for more this year, modestly.
Plus, the balance sheet is solid. They just boosted the dividend 10% and authorized another $1.5 billion in buybacks. That's a serious chunk for a company their size, $7-8 billion market cap?
Exactly. And remember the strengths. Brand elevation working, 8 straight years of AUR growth. International booming, Asia up 20% in Q4 on a tough compare. Europe up 16%. International is now 57% of the business.
So the thinking could be, maybe the market's too focused on that second half U.S. caution. Maybe it's underestimating the resilience of that higher-end consumer they've cultivated, or the sheer power of that international growth engine.
And the impact of the buybacks and continued margin execution driving EPS, even if the U.S. does slow down a bit.
Yeah. Could that cautious H2 guide be Well, overly cautious, setting themselves up to potentially beat lowered expectations that the sky doesn't actually fall. We saw that happen around the holidays, right? Where fears didn't fully play out.
So the potential play is leaning in, betting the buybacks and the international strength provide a sort of floor.
Right. And any positive surprise, maybe the U.S. holds up better than feared, or they manage the tariffs, really effectively acts as a catalyst. It's not a sure thing, obviously. Tariffs are real, the U.S. consumer could weaken. But
does the setup offer potentially asymmetric upside?
Yeah.
Where the known strengths might outweigh the forecasted headwinds?
That's the idea you'd be exploring there, a bet on execution and resilience against maybe overly conservative guidance.
Okay, so wrapping this all up, Ralph Lauren finished FY25 strong, hit their targets, executed the plan.
Yep, heading into FY26, they see growth, especially internationally. Confident in the brand, the business model, the balance sheet.
But there's that clear note of caution about the macro picture, particularly for the U.S. in the back half of the year.
Yeah.
Even though current trends haven't shown that weakness yet.
Right. So they'll keep investing brand, core products, key cities, while also returning a lot of cash to shareholders via dividends and buybacks.
And remember, everyone, none of this has been financial advice. We're just dissecting the earnings call information.
Exactly. For informational purposes only.
So maybe just a final thought for you to chew on. With all this focus on elevating the brand, targeting that less price-sensitive shopper, how much protection does that really offer if we hit broad economic turbulence?
Yeah, is even that elevated consumer immune to sustained pressure? Rising prices everywhere, global uncertainty. Where's the tipping point?
And think about them buying that flagship store in Soho. In this digital age, what does that big bet on prime physical real estate tell you about their long-term vision? Something to consider.